Thanks for tuning in to this broadcast and of Talking Point. And I think we have a new kid on the block getting listed today as well. Here's the ringing of the gong. GPT Healthcare, remember, got subscribed about 8 times or thereabouts. And let's get the stock price up on the screen if we can, please, and just see what it is doing. 15% higher on open. So much unlike Juniper Hotels yesterday, which had a subdued listing, GPT starts off on a good footing for now, about 18% higher on a subdued day for the markets as well. So not a bad start. Let's see if it sustains this. Remember, like I said, you can't compare a hotel and a healthcare stock, and the subscription numbers anyways were different. So suffice to say, worked out this way. Okay. Now, thanks for tuning into Talking Point. I'm Niraj Shah, and our case for a chat today really focuses or centers in a big way around the retail participation in equities and whether that is set to rise, very likely so. But could the SEBI caution around SMIDs result in some bit of extended heat for some of the small and mid-cap stocks? That is a key thing to monitor as well. The other question that we ask is, for the markets to do well, it is natural that the heaviest weightage index, which is banks, have to do well. Could 2024 finally be the year of banks? Because 2023 was anything but that. To talk about all of this and more, and talk about some of the key news flow today, we have with us Nimesh Chandan. He's Chief Investment Officer at Bajaj Finserv. Nimesh, good having you. Thanks for taking the time out. I hope all is well.
All good, Niraj. Always a pleasure to be in conversation with you.
Thank you. Likewise, Nimesh. Just the cautionary tone sounded off by SEBI. It's not the first time that experts have spoken about it, just that when SEBI comes in, when SEBI uses the term froth, it makes people stand up and take notice. I'm wondering, when you're thinking about this space, are you concerned per se with the overall valuations? Or it may not matter as much because, yes, the overall valuations may stay elevated, but there will always be pockets wherein smart investors can find good growth stories.
I think, Niraj, for the couple of months now, or maybe a little more, fund managers, CIOs have been coming on television and talking about that when a certain category gets into very high expectations and overvaluations, you need to be a little cautious when you are picking companies or themes from that side of the market. And small caps also have been in discussion in that same lens, that they have rallied significantly in the last year. And now when you're looking at businesses in this space and investing in this space, you have to be a little extra cautious considering the overall valuations. Not that you would not invest in a small cap. So for example, at Bajaj Finserv AMC, when a good business comes as an idea for us, we don't immediately cut it off because it's a small cap. But obviously, we look at a little more cautiously as to what valuations the company had and what is it trading at today, what kind of expectations have already been built in by the crowd. And ultimately, investment is about understanding the difference between what you think is the intrinsic value of a company and what market is or market prices have already built in terms of expectations. So a lot of experts have been talking about it, and I think SEBI also wants to just hint to people that just be cautious here. It's not that there are no good businesses in small caps or not companies worth investing, but just that you have to be cautious about liquidity, volatility in this segment. I think that's the main message.
Yeah, most certainly. I'm still trying to get to this idea, Nimesh. A clutch of sectors, a clutch of newer avenues that have opened up in India. I mean, the PLI beneficiaries, sectors like chemicals, etc., just don't have a large cap presence, maybe one or two. But some of the high growth companies, potentially longer gestation companies of growth, are currently mid caps or small caps. Because, I mean, by definition, small caps and mid caps, the average market cap has also gone up, right? So, or by performance. So my limited point is, yes, it's good to be cautionary in this space because the stocks have gone through the roof in multiple areas, but it still remains possibly the best hunting ground for longer term growth stories, doesn't it?
Oh, you are absolutely right, Niraj, on that. There are, as I said, there are very good businesses here to really pick from. And see, overall, we are in a very beautiful situation in the country where our macros are doing very well, much better than I have seen in my career compared to some of our peer countries where we were generally compared to. We are doing much better in macros. Our corporate earnings growth is extremely good. It's doing very well. It's well diversified. So the earnings pool that contribute to the growth in the overall Nifty or in other indices, that pool is very well diversified. So India is a beautiful market for stock pickers to really build a good portfolio. And we are bullish over a longer term about the all the categories, large, mid, or small. There is wealth to be created. But often what happens is when markets get excited, they discount multiple years of growth in a particular business or in a particular category or say a theme, and they give the value for it today. So what happens is even if those growth prospects, the potential translates into reality, if we have already factored that in our current estimates and in the current price, then the price doesn't see that change. And life is lived in cycles, but people like to project it in an Excel sheet in a straight line. Whenever there is even a small downturn in those areas where people have high expectations, then the stocks collapse very quickly. See, the intrinsic value or fundamental value, however vague concept it is, it acts as a magnet to the price. Many a times people move ahead of pricing some opportunity very high very soon, then it has to correct. Sometimes people get depressed, like some of the areas you mentioned in PLI. For example, look at the chemical sector. Last 3 years, it's been a big underperformer. So now, when the businesses actually they come up from this slowdown or downturn that they've gone in, you'll see the re-rating also coming in when the numbers come back. On a longer term basis, ultimately stock price follow the earnings growth or the profit growth in a company and the sector.
Okay. Nimesh, 2023, okay, firstly, are you constructive on markets currently, or would you believe that tactically, if you were to play tactically, if your mandate allowed you to play tactically, would you sit on a larger pool of cash?
I'll do better than that for you, Niraj. So we actually split our, so we launched a balance advantage fund which uses fundamental and behavioral indicators. So I just split the view from there. On a fundamental basis, and this is the large cap view, on the fundamental basis, we are at the intrinsic value, very close to the intrinsic value of the Nifty. That's, we calculate a number of parameters and we come to this. And we've done some back testing, and this intrinsic value we calculate has historically been like a regression line around the Nifty. So we are okay with that. That this is the steady state of the pendulum, that this is the intrinsic value. Now, market doesn't stay at intrinsic value. It moves around that intrinsic value based on the sentiment or behavior or the expectations or the participation bias of the crowd. Now, there is a behavioral indicator we've created which tells us that. So now that indicator is still bullish. We look at 4 different markets, 16 different parameters to look at it. But that indicator is still bullish right now. So markets are at fair value, but can trend higher in the near term. So as you said, tactically, they can trend higher because of the bullish sentiment. There is no letdown in terms of that.
Got it. Okay. Okay. Point well taken. Now, just wondering for 2023, Nimesh, one can argue that among sectors which did well, banks as a fundamental performance didn't have a bad year. Maybe because of supply or whatever, the larger poster boys have consistently seen a pullback, whereas maybe there are some idiosyncratic mid-size, small-size banks which have done okay. My larger question is, do you envisage a situation wherein 2024 could be a year wherein banks could maybe do well despite maybe potential NIM compression, but because supply side issues ease, maybe the stocks may do well relative to what they did in 2023?
Okay. Let me first come to the market perspective
Sure.
and then outlook from our side,
Sure.
especially on the banking sector.
Sure.
There are 2 things that impact the stock price movement in the near term. So typically you will see the crowd always looks forward, right? We don't look at historical numbers and then look at the stock prices moving. The market looks forward as to what is expected in the future and then tries to discount that into the prices. The second part or characteristics of the crowd is that when we are in a bull market, when markets are moving up rapidly, people want to they reduce their investment horizon, they shorten their investment horizon. So they look at very near-term data, month or a quarter that way. Now, if you combine these two characteristics, people are looking forward, but they are looking at very short term. Any sector or stocks where you see there is a near-term trouble, people don't want to invest in it. People try to ignore it, saying, okay, I would make quicker money somewhere else, and they start moving there. And that leads to these valuations getting depressed in companies that have shown some historical good numbers, but are looking at some short-term issues, maybe a quarter or two in the future. I think that's what's happened with the banking sector. We look at banking sector now coming to a fundamental view on three different aspects. You look at asset quality, you look at their net interest margins, and you look at the credit. Their asset quality is good across banking sector. We, I think, are swimming in the best of times in terms of asset quality. In terms of net interest margin, there is some pressure expected as deposit rates start going up. So there could be some near-term pressure in the margins of some of the banks. And the third is credit growth. I think if India is doing capex and consumption is expected to do well in India, even credit growth will be healthy. I don't think it, maybe again for the near term, between net interest margins and credit growth, some companies may choose margins more than growth. So that can lead to some changes in numbers in the near term. I think this is the reason why banking sector, despite giving good numbers last year, has in the near term underperformed, and especially some of the private banks, because they are seeing a little more pressure on that in terms of deposit growth. But these are short-term issues. In the longer term, the banking sector is extremely big, large part of the economy, very important for various indices and for businesses. So I think for a long-term investor who can look beyond these short-term issues can take opportunity of picking up some of these companies at good valuations.
Let's talk about a big merger story from Dalal Street. Reliance and Disney signed a binding agreement to form a 70,000 crore joint venture. Reliance has started off on a positive note, but the other allied entities haven't. And maybe this entity impacts some of the other media businesses in the country too. Smriti Chaudhary Johnson to tell us more about the details of the merger and its implications. Smriti?
Good morning. Yes, you mentioned about the valuation. That's the whole valuation of about 70,000 crore rupees. But let's kind of break it down a little bit and look at the individual valuations. If you look at the valuation of Reliance Media business as a whole, it comes out to be around 40,300 crore based on the stake in the entity. But if you look at the investments they have made in their media business, that's close to about 40,100 crore. So not a lot of value accretion that's happening for RIL from the looks of it. If you look at Star India business, that's valued up at about $3.14 billion. This is a sharp decline from its valuation from pre-COVID levels that was pegged at around $14 to $15 billion. $14 to $15 billion. That's according to Elara Securities. So a sharp valuation decrease for Star India business as well. However, for Star India, this ends a long struggle that Disney has been facing in India. They've been losing subscribers after they lost IPL rights to Viacom 18, and this is the digital rights that they lost. But there's a lot of synergies that are kind of coming together for this joint venture. If you look at the total number of channels, they'll have more than 120 channels and 2 OTT platforms. They'll have access to over 750 million viewers in India itself. They will also have a monopoly in cricket, and this is in a country which is a cricket-loving country. Viacom 18 owns digital rights of IPL, Disney owns television rights for IPL. But both of them are struggling to monetize these rights. Just to give you a little value of how much these rights are worth. They bought these rights at a combined value of $6.5 billion. Now, Disney also owns ICC rights from 2024 to 2027. The merger, however, is set to improve the income for Disney's sports segment that they've been struggling with in India for a while. This will also limit the volatility of net additions, net viewers for Disney as well. Now, overall, the earnings contribution for RIL from the merger remains small in single digits. This is according to Morgan Stanley. But it provides a pathway for RIL to kind of leverage on their digital platform and improve returns and monetizations.
Smriti, thanks for putting that into perspective. Nimesh, come in on this one. It's a space that has largely not created wealth for a number of years now. Is the space consolidating? Is that good for broadcasters? Or does something like this, a behemoth getting created, create issues for some of the others, particularly in the GEC space?
Without commenting on a specific company,
agree completely.
I would say the consolidation is the way forward here, actually. And this is where we had so many companies coming out with OTT platforms, and I'm sure, many have certain pockets of niches where they are very strong. Obviously, the merger that you were talking about is two mega, large platforms coming together, and it will definitely have impact on the other players in the industry, and quite significant.
Okay. Sorry, just trying to understand this better. So, if at all, would you be constructive on media at large, or would something like this kind of make you stand up and say, let's see how things play out, we can take a call later on?
So we have very little exposure to media space. We have it through conglomerate only. We don't have a direct exposure much in the media space. We have better opportunities or growth stories right now in the other sectors. And this sector we'll watch for some time before taking a decision.
Fair call. So where are these opportunities now? What are the first amongst equals, Nimesh, to your mind?
So, Niraj, anything that is right now visible on the table, where you can calculate earnings and come to a PE ratio, everything seems to be now fairly valued or discovered. And you can play a compounding story from here in some of these companies. But if you really want to pick up really high compounders or high growth now in, say, wealth creation, one has to look at the market with a contrarian streak a little bit, or look at companies which are going through some short-term trouble, businesses which are going through some short-term downturn, and where the crowd has either overreacted to a negative that has come, or not reacted to some turnaround or positives that are happening. And so if you go fishing right now, where you may find more fishes and less water, so your chances of a hit rate are better, are those companies or sectors which have underperformed for the last 3 years or 4 years, and find there. I find a lot of companies which used to be among the companies called quality at any price in somewhere in 2018 or so, and now for last 5 years, 6 years, they have not performed. Their earnings have grown, their intrinsic values have gone up, but these companies, the stock prices have not, because they've not been exciting stocks to be there or exciting themes to be there. Several of them are in the consumption space, where one can find very good opportunities to pick up some of these companies across market cap categories. And private banks we spoke about is one such category also.
Private banks is one such. You mentioned consumption. I was almost going to say that something tells me that you are referring to chemicals / pharmaceuticals, but you mentioned consumption. So sorry. Let's talk about consumption first.
So Niraj, add chemicals to that actually.
Achha, okay, fine. I wasn't completely wrong then. Okay. So, let's start with consumption. Nimesh, the overarching view all of 2023 was that consumption is in this K-shaped pocket, wherein the upper crust of the K, premiumization is doing very well, and the lower end isn't doing well. The volume growth isn't coming, the pricing power is not there. There is local competition which is eating into pan-India players. Is that changing, or is that the consumption you're referring to?
So for now, it is not changing much. So this K-shape continues even till, say, the last quarter numbers that we see. We've seen a more premium and higher end consumption doing very well, the lower end not so much. Some reflection of that can be that rural has not done much and urban has done a little better. You would find areas like travel and tourism, hotels, these have done better than, say, the FMCG counterparts. Within cars, you see SUVs doing very well rather than very low end cars. So that K-shape frankly continues till now, but there are green shoots of a bottoming out or pick up in the rural side, pick up in some of these other areas also. So we are actually looking very closely, keeping a finger on the pulse of the economy to see if there are any changes happening on that side. And because that's where market is quite pessimistic about, or market is not looking at any immediate trigger. So those are areas we look for whether the valuations of these companies are attractive, whether the business can go back to growth. See, again, we just finished analyzing the festive season, but frankly, again, in 2 quarters, we'll be talking about the next festive season, the next monsoon season, and you can't say that because the last one was like, had a certain X or percentage of growth, next one will also be the same. So we can see some pickup there. We are seeing some green shoots coming in the rural side. So consumption is an area where we are looking for a pickup. In terms of chemicals, a lot of them saw some pricing pressure and volumes being under pressure because of inventory build-up. Now it's a large space, though we have to look at company by company, but generally I can risk one generalization that there is an improvement across some of these chemical prices and volumes also, maybe a little bit of improvement, bottoming out kind of going through. But again, when you look at 2-3 quarters down the line or 2 years, 3 years down the line, uh, these are some of the companies which are beneficiaries of PLI, beneficiaries of China Plus One, beneficiaries of global sourcing. So I think there's an opportunity there. Again, a small sector I'll add to this also that real estate has just started doing well last year. We saw real estate possibly continues for the next 2-3 years. And when real estate grows, it affects so many different sectors positively, whether you look at cement and steel positively on, say, tiles, faucets, some of these building materials that come in wires, cables, consumer goods. So those will also start seeing an improvement. Right now, the market is not factoring in much from there, but that's where some of this opportunity lies. If you can pick up good brands at reasonable valuations, they can be your compounders.
Okay, okay. Nimesh, just one quick follow-up because we are out of time completely on the show. But do pharmaceuticals fit the bill as well? An underperforming sector starting to show some turnaround?
Oh, absolutely. I think pharma sector has again some similar long way to go. Some part of the rally has happened. So I would say that US generics side of the business has got good discounting. I think people are now re-looking at some of the domestic stories, especially MNC pharma side. We are very much interested in contract research and manufacturing side. As we are expecting interest rates to go down, global funding for some of these small biotech companies or pharma companies is expected to go up. And India is a fantastic partner in contract research and manufacturing to many of these companies. So there is a lot of interest for them. So we picked up these smaller, or we looked at these smaller pharma companies which are involved in contract research and manufacturing and have capabilities to take from kilo lab to tons. And those can be the dark horses, or those can be the areas where pharma can also be.
Nimesh, so good talking to you. Thanks for taking the time out and being with us on the show today. Really appreciate your time.
Pleasure. Thank you, Niraj.
Thank you. And viewers, thanks for tuning into this edition of The Talking Point.